In a world where markets are bombarded with economic news every day, how do you know which data is worth paying attention to or not? Well, in this lesson, I'm going to explore a simple but powerful tool. It's our three-step analysis process. It's what I use to help me separate meaningful data from the noise. It becomes intuitive after a while, but when you're learning, it's good to learn it step by step. Now, why is it that some data moves markets and some doesn't? You've probably seen it before. A major data release hit the wires and the markets barely even flinch. Other times, something that looks really minor sparks a really big reaction, and you might be thinking, well, what's going on there? And that's because headline importance isn't everything at all. It's the context that drives how the market responds. Your job as a trader or analyst is to understand that context so you can focus only on the data which really matters. So what I want to do in this instance, I want to take you through a real worked example. Now, this was a real trade that I was sharing with clients in December 2024. It was the Bank of England interest rate decision. And it was to do with the way that the central bankers voted. There was a vote split that meant an opportunity was there. Now, the baseline. What's that baseline? Step one. UK recession fears were rising. Markets were looking at the UK economy and saying, oh, the Bank of England is going to start to need to cut interest rates to stimulate the UK economy. But there was a problem. Inflation was still high. So the Bank of England was struggling with this twin driver. They want to stimulate growth, but inflation is still a little bit too high. So at what point does the weakness in the UK economy mean that the Bank of England say, no, we have to prioritise stimulating growth now, even if inflation is a little bit too high? So going into this Bank of England meeting, it was clear UK recession fears were rising. The need for interest rate cuts were definitely increasing. So what would have been the surprise? Well, the surprise on this Bank of England decision would be if the Bank of England members suddenly show that they were more concerned about stalling growth than sticky inflation. And that would show up in the vote split. Now, markets were expecting 2 Bank of England members to vote for a split, but in the end, the market was surprised with 3 members voting for a vote split. So the base case was 2, but the surprise was 3. Did it change the bigger picture? No. So it wasn't such a decision that fundamentally changed the path ahead for the UK. Markets were expecting a turn to come, and this is maybe the turn is coming slightly sooner. So does it massively change the big picture? No. Is it a small tweak? Yes. So it was a tactical short-term scalp setup rather than the big swing trade. So what actually happened? The vote split that we wanted occurred. And that vote split was a clear recognition by the Bank of England that interest rates were coming. And when we looked at the Bank of England data, you could see in the vote split record, more members want a vote cut. That's what we needed. The opportunity at the time was to go short the pound against the dollar. It was a quick, short duration trade that you can see moved in one direction. So I'm going to share with you now the record that I took of that release at the time. Don't worry that you don't have to look for this setup every single time. This is just illustrative of how to use this 3-step process of the baseline, the surprise, and the bigger picture. So here you can see how that played out when we originally took the trade all the way back in December 2024. Why do we look at the economic calendar? So that we can spot high probability opportunities. Now, here's one in the pound on the Thursday, the 19th of December. What we were looking for here was a vote split from the Bank of England that indicated members of the Monetary Policy Committee were more committed to interest rate cuts moving forward. And we saw the vote split that we wanted. In the cheat sheet here, we just highlighted if we saw a vote split of 3 for a cut, 6 for unchanged, then we're to look for pound dollar sellers at market. You can see here that's exactly what we got with the decision. And if we go and just take a look at the interest rate decision here, you can see here for Thursday, the 19th of December, you can see that vote split came in here. Look, 3 for a cut, right? 6 for unchanged. That was the opportunity we're looking for to sell the pound. You can see the pound dollar fell off very distinctly from that drop. You can see move lower on the spike and then a potential trend line break lower that just carried on throughout the rest of the session. That's why we look at the probability, high probability calendar events, because they provide high probability trading opportunities. So what does it teach us? Remember, the value isn't in the outcome. This is about the preparation that we took. The 3-step framework helped us to identify when data was going to be meaningful, you see. It told us which data to look out for. Then it helped us see what the surprise would be. And finally, it defined whether that surprise changed the bigger picture or not. And by using this method, it allows you to prepare with intention so that you're not reacting emotionally, and that means that even simple data releases can offer strong risk-adjusted opportunities if you know how to evaluate them. You see, in this instance, it wasn't the interest rate decision, it was itself that was the market mover. It was simply the vote split. And there's many instances where relatively minor data points can have outsized response in the market when you know what to look for. So remember, you want to look at the base case so you can recognize what the surprise is, and then you ask yourself the question, does that change the bigger picture? Base case, surprise, bigger picture. The 3-step analysis process to help you stay the right side of the market.
Some prints move markets, others don't. The key? Context. Use a 3-step process: baseline, surprise, and big picture. Step 1. What's expected? If the data meets expectations, there's no big reaction. If it's a total surprise, that's when things move. Step 2. Is it a shock? A small beat may not matter. A big miss might. It's all about how far the print deviates from forecasts and from what was expected. Step 3. Does it change the story? Will it shift central bank policy or market narrative? If yes, then that's your opportunity. If not, then it may not be.
Now in this lesson, I'm going to start to unpick how you do this in real time to work out which economic data matters and how we apply this 3-step analysis process. Remember, we want to see what's expected, what the surprise will be, and what the bigger picture is. Now, you may have seen it before. Some data is incredibly impactful, others isn't. Now, you have to know that not all high impact events create big reactions, and not all low impact events are irrelevant. It all depends completely and utterly on the context. Now, headline importance isn't everything. Just because it says on the calendar this is high importance, it doesn't mean that it is. Your job is to understand which data really, really matters, to focus out the irrelevant from the relevant. And this is how we do it. So we're going to begin to go over this 3-step analysis process again. We have to think to ourselves, what is expected? And that means, what are markets expecting when this data point comes out? And that's how we recognize the surprise. So you have to think, well, what is the market assuming? Is growth really strong? Is inflation really high? Is the jobs market really weak? What are the assumptions there? And when you know the assumptions, that shows you what the surprise will be. So, for example, if it's assumed that inflation is going to remain really high, and because inflation's really high, if there's suddenly a big miss in inflation expectations that suddenly comes right down, that's a surprise. Okay. Now, will it change the big outlook? If it's one inflation print, probably not. But do you see, it would be a surprise and a shock to markets. And you have to look at what the latest macro condition and situation is. So, looking at a simple example, okay, to establish the baseline. Let's look at, say, the Federal Reserve has been hiking interest rates for months. Okay, so it's been hiking interest rates because inflation's been high. High inflation has led to higher interest rates. And now we've got a inflation reading that's coming out. Now, if the inflation reading is high again, is that going to be a surprise? No, it's not going to be a surprise. Is it going to change the Fed's course? No, it isn't. Because why? The market was expecting high inflation. And then high inflation came out. So the market just goes, okay, fine, that's what we were already expecting. That's what we'd already priced in. So what you want to do is understand what's going on, assess recent market behavior and action. Then ask yourself, well, if this is a miss or a beat in the data, will that change anything? And if the answer is no, the data likely won't matter much. It won't move markets probably at all. Now, let's look at another, example. Okay, that's the example there where the expectation is all priced in and the Federal Reserve has been hiking interest rates. There's one CPI. If it's a beat, if it's a miss, would it change the policy path? Probably not much at all. So it's going to have low market impact, even though inflation is important. And we've already looked that growth and inflation are two of the most important things for an economy. In this scenario, the inflation print wouldn't matter. But let's look at a different baseline, one that's fragile. So let's say, for instance, growth and inflation have been showing signs of slowing. Maybe there's been a GDP print that's come out below market expectations. Maybe there's been some weak PMI prints coming out. And maybe there's been some talk of inflation expectations falling as well. And perhaps the Federal Reserve has started to say, we're seeing signs of slowing in the economy. We're seeing signs of weakness in the labour market. Now, if there's an inflation reading coming out, and say that surprises to the downside, then would that surprise market? Yes. And the market would be very sensitive to that. And you could likely see the market sell off sharply because the lower inflation print would mean that the central bank is much more likely to cut interest rates, just like we saw with the Bank of England. You saw slowing growth, worries about growth, and then, you've got the vote split. But this is exactly the same. Say you had worries about growth, worries about inflation, then all of a sudden a low inflation print. Is that a surprise? Yes. And the market's really sensitive to that data. So you tend to get the bigger reaction. And then finally, once you've identifying the surprise, you got to ask yourself, what is the market expecting? Okay? You got to think, is this enough of a deviation to shape the market's view? If inflation comes in, well below market's minimum expectations, then yes, it can be enough. So you got to think the direction, the size of the surprise, and the bigger the surprise, the bigger the move. Okay? You've got the 3-step analysis process, the baseline, the surprise, the bigger picture. Then finally, you got to zoom out and ask yourself, is this data going to shift the bigger narrative? If not, it may only create short-term trades, okay? Just like we saw with the Bank of England short-term vote split. It created a short-term pound-dollar short opportunity. But if the change is fundamental and will challenge the central bank expectations, will challenge growth outlook or challenge the policy path, that is a potential inflection point. And that's when surprises don't just move prices, they change the market's direction. The market can be in one direction, then there could be a data point that shows a significant change. It could be, a very weak labour print. Suddenly there's a terrible non-farm payroll print, and that's going to cement in a series of interest rate cuts from the Federal Reserve. It can sometimes come down to 1 or 2 data points. And the way you find that, you just ask yourself, will that change the bigger picture? Because sometimes the answer will be yes. It will change the bigger picture. And that's where you get those swing trades, those longer term moves. So finally, when we're looking at the three-step analysis process, don't just look at data importance tags. Don't make the mistake of saying, oh, that's high important, that's low important. They don't tell the whole story. Remember that one data point can just be noise unless it changes the trend of policy expectations. And what you do, and I'll show you how to do this, you'll see what the central bank is focusing on. Because when the central bank's focusing on a data point, that's when a surprise tends to have much more of an impact. The baseline also helps you ignore irrelevant data. If like the labour market's not in focus at all, and there's a slightly hotter or slightly weaker, employment print, it's going to make very little difference. Okay, so by using the three-step process, you can plan. And what I do is I look at the economic calendar coming up for the following week, and I can see the data that's already in focus. And hang on, okay, inflation, that's particularly in focus for whichever country. Oh, and maybe it's a labour market print for another country, and you can see, oh, okay, I've got two major data points coming up this week. And then you start using your process. What's the baseline? What will be the surprise? And what's the bigger picture? So I hope that begins to help you internalize this three-step analysis process. Let me assure you, it does become a relatively simple, and it's not a complicated process to use. And I'll also show you as we go through this how to look at central bank communications, because they actually tell you which data matters.
Filter the noise. Not all data moves markets. What matters is context, not the calendar. Step 1, baseline. What are markets expecting? If the data doesn't challenge that, it won't move the market. Step 2, surprise. Big surprise? Big move. Small surprise? Probably nothing. Step 3, bigger picture. Does it change the story, like growth or central bank policy? If not, it's just noise. Key takeaway? Use the three-step filter. Baseline, surprise, big picture. That's how pros stay focused.
Now in this lesson, I'm going to show you something important. We might know which data is going to move markets, but how do we know when the economic data print is big enough for a tradable opportunity? And in this lesson, I'm going to show you how you turn the numbers into action. And again, when you know how, it is relatively simple. So the three-step process has told us when to anticipate if a release matters. What's the base case? What's the surprise? What's the bigger picture? But what about the actual number? How do we know if the actual number is a big enough a surprise or not? And how do we know if it's trade-worthy and worth risking our money? So the way to assess this real data is based upon the economic calendar that we use. Now, every economic calendar data point has what's called a forecast consensus. Now, this is based on the survey that's taken from economists and professional analysts to ask them what they're expecting to come from the latest data release. It's also known as the market's base case. And you'll see that forecast number that's given in both free and premium calendars. So you will know what the expected release is. Now, a premium calendar, one you pay for, goes one extra step further, and it's a crucial step because what a premium calendar will do, it will show you the minimum estimate and the maximum estimate. So what it does, it shows you of those analysts who are forecast, which analysts were on the low side and which analysts were on the high side. It shows you that range. It may not show you the individual analysts always, but it will show you what those range of expectations are. Now, this range is crucial because all very well knowing that non-farm payroll might be 100,000 jobs are expected to be added to the US economy, but how many analysts were thinking it would be 150, 160,000? How many analysts, if any, were thinking it was going to be 40,000 or 30,000? The range shows you where the high and where the low is. Do you see? So that helps you spot when a result is truly surprising, because if it falls outside of that range, look, it surprised everyone. So it's a great potential opportunity. So when results break the range, that's how you know it's an economic data point that's worth your attention. Remember, it's not just data that breaks the range that's important. You have to still do the three-step process first. It's then when you've done the three-step process and then you see that data point break the range, that's when you know you've got that better than expected opportunity. Now, premium tools will sometimes flag this with icons like a lightning bolt showing you it's outside the range. It will be obvious. There'll be one, identifying factor on the calendar release, so you can instantly see, aha, that is outside the range. And when that comes in, it's a much higher chance of volatility when you actually see that data release. Let me give you an example of it. Here's the non-farm payroll. And you can see here in the calendar, highlighted in red, the calendar shows you the forecast. You can see the forecast there, 110,000. And then you can see in the columns to the right of that forecast number, the low and the high expectations. Can you see that? The low and the high. So that tells you that if the actual non-farm payroll release comes outside of the low and outside of the high of that range, that's truly a surprise. So for instance, if you're looking at this data point, you're thinking, okay, if it's a low surprise, that's going to really surprise markets. And then all of a sudden the low comes in below the market's minimum expectations. If it comes in 20,000 jobs, look, it's the surprise that I'm expecting to move markets. See it almost like a shock score. The more outside the range, the more fuel there is for market reaction, because the greater the shock factor. Now this matters for trading because those large deviations give you that tradable volatility, and it helps filter out the noise from ordinary prints and just gives a trader an edge, and it's an edge over those basic calendars. So remember, you're not just looking at what's forecast, you're looking at the range of what's forecasted, and that tells you whether there's truly a surprise. So as we summarize this lesson, remember the consensus is just the average. It's surprises that happen outside of the range. Premium calendars will help you quantify what's truly surprising by giving you the range of analysts' expectations. Finally, you must combine this with the three-step analysis process in order to spot tradable opportunities. And when actual outcomes do break those expectations, that's when you need to be ready to act.
When is a data print big enough to trade? Consensus isn't enough. Every release has a forecast, but smart traders also look at the full range of expectations. That's where the real signal hides. Min-max forecasts is the surprise gauge. If a number lands outside the range of analyst estimates, that's the shock. And that's the potential real trading opportunity. Watch for breakouts. When a print beats or misses not just the consensus but the entire range, markets react fast. That's your moment to act